Good morning, everybody, and welcome to this week's weekly analysis session, February 15, 2016. Let's get straight into it. Our disclaimer first and foremost. Once my PowerPoint catches up with my clicking, and we've got the circle of death. So it's a good start to this particular week. I reckon I just about know the disclaimer off the top of my head, so we'll give it a go. The content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your financial circumstances or particular needs. So please, before taking any action based on the content of today's presentation, please check that the content is in line with your own investment philosophy, or seek further advice on the appropriateness of the material. Keep my fingers crossed. Let's click the button and see whether we can go through to the next step. Oh dear, isn't it wonderful technology? There we go. We'll probably end up with a whole lot of clicks. Let me see if I can go through to the next slide. Certainly been a bit of a mixed weekend, hasn't it? On Friday, we had, towards the end of Friday afternoon, certainly noticed when I was looking at the markets while we wait for my computer to catch up, that the Japanese yen started to sell off, which was interesting because over the last couple of weeks, there's actually been quite a bit of strength in the Japanese yen. That was starting to sell off before I left work on Friday afternoon. And at the same time, oil started to move. When we did the macroeconomic analysis session, oil had actually already jumped about 4 or 5%. So it's interesting. I don't know how many of you managed to go through and look at the macroeconomics analysis session that Jeff and I did on Friday, but we talked a little bit about that. We talked a bit about the impact of the oil rout on the global banking sector, and certainly that's having a bit of an impact, particularly on European and US-based banks. So we discussed that at quite length. We talked about the flight to safety as well, and obviously some of the safe havens around the world have typically been the Japanese yen, as an example. Bonds is another example of a flight to safety. So money coming out of the stock market into bonds, into Japanese yen in particular, and also to a certain extent into gold. And so you'd seen the gold index, gold stocks of recent times performing actually very well. On the basis of that sort of risk-off type of positioning. Late Friday afternoon, we did start to see some of that turn around a little bit, and wasn't surprising starting to see some of that late on Friday afternoon that we got a bit of a rally in the market as some of those risk-off assets, if you like, came off a little bit over the course of the weekend. I'm not too sure whether my PowerPoint is going to catch up with me or not. It's playing tricks at the moment, so let's just, what I might do is see if we can go into beyond charts if my PowerPoint's not going to play fair with me. So there we go. Let's go through and have a look at the indices. We can go back to the PowerPoint a little bit later on. Certainly the first things first, thinking about our market risk at this particular point in time. Last week, it's interesting, isn't it, when we look at the stochastic there, certainly a lagging indicator. Price action is, as always, the most current of indicators, reflecting day-to-day movements in the broader benchmark. You'll see there on Friday that our own market, in fact, all last week, really sort of sold off fairly heavily. And we were just, last week, you might remember, we just ticked over into very high market risk, and it was only going to take pretty much really sort of one down day for that stochastic to roll over. And it has, with several down days, now rolled over into extreme risk territory. So it's really just telling us, look, at this particular point in time, we're well entrenched into a downward moving market. If you do have to be invested, then you're really only wanting to have a small amount of your capital exposed on the long side of the market. So again, protecting your capital is very, very important. At some stage, the markets will turn around. They're not going to be in a bear market forever and ever and ever. and when they do, you'll have plenty of capital available. So that's really important to remember that you don't want to be fully invested as the market is on a downward path. The volatility you'll see is still at extreme levels, well above its longer term moving average, and that longer term moving average, the thin red line there, you can see that's been progressively moving, sort of sloping upwards over the longer term as well. So that just goes to show you that we're going to have big swings in the market, both to the upward side and the downward side, and that makes it any short term trading a bit tricky. Because you've got to be prepared for some fairly significant swings. If we go through and just have a look, and hopefully Beyond Charts will cooperate with me, at the US benchmark, you'll see there Beyond Charts is just thinking it must have had a difficult weekend. It was all working very well before we clicked on record. Always check to make sure that everything's functioning smoothly before we go live. And it's a bit like being an actor in a stage show, isn't it? Everything will be all right in the night, and you always hope that it will. Come on, Beyond Charts. I know you can do it. It's first thing Monday. And with the lag in this, there we go. It's one of those things, if you click twice, then all of a sudden it goes through a couple of screens at once. Here we go, our S&P 1500, the benchmark there. Really interesting. I've put this line on here a couple of weeks ago just to sort of see, relevant levels. We'd broken through that level a number of weeks before, and we were looking at whereabouts we might be able to rally to. We haven't got up to these previous highs yet. Before turning over again. So we've had a fairly big night and a big candle there on Friday night, and I'll just zoom in a little bit there. So the question is, how far will we bounce from here? Now, not really knowing, where this is likely to go. The areas where potentially it could go, the first test level really is around this 432 level, where we've had a test once before. If we can close above that, then certainly what that's going to bring into the market is a lot of short covering. So any traders, as an example, hedge funds, etc., that are short at this point in time are going to be wanting to protect those positions. And so to get out of short trades, to cover those positions, they have to buy, obviously, to close those orders, and that can add a certain amount of fuel to an upward move. So this is obviously the first level that we're going to test, so it'll be interesting to see what the market does when we get to that particular level. If we happen to close above this pin bar here, then obviously the next level above that is you're looking at it getting close to that sort of 450 on the S&P 1500. So we'll just have to wait and see how the market behaves. Certainly, it's not the start of a new bull market at this particular point in time. We're well below the longer-term moving average, as you can see, and it's going to be, that's the next level. Should we happen to, close above this previous peak up here, then that's the next level to be tested. But that's, the market's going to have to do a lot of work. And what's really changed since Thursday of last week? Well, not a hell of a lot, really. Oil's had a bit of a bounce. There's lots of talks between the oil-producing countries that trying to reduce supply to prop up the price of oil, but then you've still got the likes of Iran looking to put more oil on stream as their economic sanctions are being reduced over a period of time as well. Certainly, if you haven't listened to the macroeconomics analysis session, go and listen to that, because Jeff certainly brings to the table some well-informed fundamental views about what's going on, on the macro levels as well. What we might do now, if Beyond Charts is going to cooperate, is just go through and have a look at. I could only find in Australia this week one new setup, and that's on a stock that we're already in, and that's on AIA. So, with a little bit of luck here, AIA, Auckland International Airport. We'll bring that one up and have a look at that particular stock. This has been a stock, AIA, that's been just on an upward trajectory all the way through, and showing just on the basis of that extreme relative strength. So I could certainly put those, the relative strength bars on the bottom, but I think we've all got a pretty good idea as to what's been going on in our market, and yet this stock defies gravity and continues to move onwards and upwards. So it's already in the portfolio, and you can see it's trailing stop there, the green line. Price action of the last month or so has actually been fairly reasonable given what the rest of the market's been doing. Last week, what it did do is it put in we've got obviously now confirmed a higher trough. Prior to last week's candle, we just had an inside bar the previous week, so we didn't have any clear direction there, so just some short-term stagnation. Now that we've got a higher high and a higher low, we're back into motif phase, so a short-term uptrend's been confirmed, so therefore new medium-term trough has been formed. Where is that trough in relation to the second from last medium-term peak? Well, there's our last one. There's our second from last one. It's well above that level, so again, showing strong demand at that point of demand there now. So it meets our price action filter. All we need to therefore do is just check that there's no other obstacles in its way, and you can see that we are in all-time highs, and hasn't it performed really, really well over the last 5 or 6 years, and continues to do so. So again, not exactly sure why this stock is going up. Obviously more demand than supply, but obviously there's some fundamentals behind it that the market likes. So our on-stop order just needs to be 0.5% above our last medium-term peak. So we have an on-stop order there at $5.83. I'll make that a little bit bigger so we can all see. $5.83, and a stop loss at least 0.5% below that last medium-term trough. That stop loss coming in there at $4.95. So on stop at $5.83, stop loss at $4.95. Now, as you can see, that's a fairly wide stop. So from that point of view, it just means that you need to adjust your position size accordingly. So a wider stop means you're going to have fewer numbers of shares or CFDs, depending on whatever entity you're trading, just to make sure that you're taking that into account. There were a number of cancellations from previous weeks, which we'll go through now. CNU, Chorus Limited is a stock there that this particular setup has now been cancelled. So we were taking an entry above the last medium-term peak. What you'll see last week is that we had a lower high and a lower low, so that actually puts us into short-term downtrend. And by virtue of that, it means that we've now formed a lower peak. Okay, so a lower peak. So our price action from this point in of time has been void. So what we want to see rising peaks and rising troughs, obviously. The fact that we've got a lower peak suggests that obviously supply is coming in at a lower level, and wherever this turns round now and moves up, wherever that next trough is not going to be above our second from last peak. So assuming this was to turn around this week and actually start heading back up, if we look at this trough where it's going to form, where is that trough in relation to the second from last peak? Well, that will be the last peak. That will be the second from last peak. Is it above it? No, it's not. So from that point of view, it doesn't meet our price action filter. So that one's going to come out of the watch list. The next one that also has to come out is Hub24 for exactly the same reason. We go through and have a look at this one. You'll see that last week's candle has now meant that we're in short-term downtrend, so therefore forming a lower medium-term peak. And for exactly the same reasons, when this new trough, wherever it forms and whenever it forms, is it going to be above our second from last peak, which will therefore be this one? No, it won't be. And again, the price action filter means that that has become void as well. CSL in Australia went very close to triggering a couple of weeks ago. So we had an on-stop order there at 108.81. If I just put on the value line there, you'll see that the high that we got to was 108.68. So from that point of view, not triggering our order there. Now again, somewhere along the way, this is going to turn around and turn back up. But wherever that occurs, you can see already that where that next trough occurs, is that going to be at or above the second from last medium-term peak? No, it's not. So again, it's going to void the price action filter. So that comes out of the list. CTX, Caltex, and this is a stock that'll probably rally this week on the back of the increase in the price of oil over the weekend. But nevertheless, we've got the formation of a lower peak, again suggesting that supply is coming in at a lower level. And again, as a result, it's going to invalidate the price action filter. So CTX is coming out. MYX, Main Pharma, another one with exactly the same sort of price action. So you can see, well entrenched in a short-term downtrend. We're in medium-term downtrend as well. It's going to take a little bit for this stock to regain its composure and therefore also tick the price action filter. So it's going to be a few weeks away from setting up once again. A couple of stop outs in the Australian watch list last week. GHC, so Generation Healthcare. Just go through and have a look at that. You'll see there that big black candle over last week closing below the 3 ATR based trailing stop. So that's a market exit this morning. So that was an initial entry there at around about $1.65 and eventually getting out somewhere around about $1.73, 74, whatever it opens at this morning. So eking a little bit of profit out of that one along the way. Of course, unless you did manage to take some profits up at that 215 level. We didn't have a price volume volatility signal up at that level, but needless to say, you would have been up around about 2 to 1 on that at that time. If you were looking to take some profits using your own discretion. BKL, Blackmores has been a really solid performer over the course of last year, and it did set up again recently. Only now being sold off pretty heavily last week and closing below its trailing stop. So the last order that we had, that's still open because we've still got in... well, actually, no, it isn't, because our trailing stop has come up past our initial 2 ATR based stop. So when that last one was set up a few weeks ago, or back in early December there, our initial stop was at 155.22. The trailing stop was, all the way down around about 140. That has subsequently since come up above that level, so we defer to our trailing stop. And closing below that this particular week. So the second setup on this particular trade is going to end up being a losing trade. Those of you who remained in it from all the way down at around $80 and have had some opportunities to take partial profits along the way, hopefully you've done well out of that and it's made a big difference to your portfolio. But even now, that initial trade will come out of the watch list because, as the rules dictate, price is now closed below that trailing 3 ATR stop. So that was Blackmores, and they were the only two stop outs this particular week from the Australian portfolio. We might go across now to the US and have a look at a couple of cancellations from that side of the watch list. CUBE, Cube Smart. So we'll go through and have a look at why this was a stock that was cancelled from the pending list. So you'll see here this was a second setup that we had on it. So the initial setup, again using the green line, the 3 ATR, the initial setup, which was the breakthrough of this blue line here, that's still all fine. Again, the green line, our trailing stop, has come up past our initial 2 ATR based stop. The other week, price nearly got up to our entry level, just falling short. The high there you'll see 31.91. Our on-stop order was at 32.03. So we didn't quite get there the previous week. The reason the previous week it wasn't cancelled was that this black candle was an outside bar. So that means that it had a higher high than the previous candle, but it also had a lower low. Okay, so that's at this particular point in time, we're still part of a short-term uptrend, but this is stagnation. Okay, we moved out of stagnation mode into motive phase. That just means moving, but unfortunately we were moving to the downward side, so short-term downtrend now, and as a result that means that we've also created a medium-term peak, and that medium-term peak is lower than the previous medium-term peak. So by default now that means that we are in medium-term downtrend, and we certainly can't be long when we are in a medium-term downtrend. And no matter where this short-term downtrend now stops and turns around and goes back up, that trough is that trough at or above the second from last medium-term peak. Well, that's the last one, that's the second from last one. You can see it's well below and therefore invalidating the price action filter. A couple of others as beyond charts goes round and round and round. EDU was another stock that is also coming out of the watch list for exactly the same reason. And as it brings that up, you'll see that we're now short-term downtrend and as a result invalidating the price action. So again, no matter where this short-term downtrend turns around and moves back up, wherever that trough is it going to be above that second from last medium-term peak? No, it's not. So it invalidates the price action. EXR, extra space storage, another one coming out of the watch list there, and there it is. So you'll see that we had a setup there, and if we just zoom in a little bit to have a look, we had the setup on the basis of this white candle. It was looking quite good. We just had to breach 0.5% above that last medium-term peak, so we had to get to 92.45. We didn't get to that level. Selling off, a lot the previous week. Again, the previous week, the reason it didn't come out is that we had an outside bar, so a higher high and a lower low. But last week we certainly got lower high and lower low, short-term downtrend, and again the whole price action filter being invalidated on that aspect. BWXT, again another stock that same sort of thing. Last week we were still part of short-term uptrend. Not a particularly good candle last week, but or the previous week. Last week certainly gapping down and having a lower high and a lower low, short-term downtrend now, and as a result, wherever this short-term downtrend finishes and turns around and goes back up, we're going to have another medium-term trough formed, and that's way below our relative medium-term peak that we want to be above for the price action filter. So those ones will be coming out of the watch list. There were a couple of stop outs from the US portfolio last week. TSN, Tyson Foods. I'll go through and have a look at. Sorry, that was a trailed stop, not a stop out. Trailed stop there, so you can see there our 3 ATR trailing stop coming up well above our initial 2 ATR base stop. And the other one, HRL, Hormel Foods, performing very strongly and not dissimilar in the way that it's been moving along as well, and that trailing stop coming up at the same time. So in fact, I'm just going to see whether I can. I did have an analysis set up on here, but it looks like I've lost it. But having a look at that, putting that back on the other day, certainly triggering past last week, triggering in that black candle there, triggering in. So this is a second setup on this particular stock, and as a result, last week's big white candle dragging that trailing 3 ATR up as well. There was one stop out, AIZ. So again, I want to go through and have a look at the good, the bad, and the ugly. And you'll see this was the initial setup through here at $80.10, which we got triggered into. We had some price volume volatility signals going off, certainly not taking any action on the basis of those. Not nearly up enough in the trade to warrant that. Price came back down. Over a period of time, the trailing stop did get dragged up, but last week you'll see earnings, big sell-off in this particular stock and closing well below its trailing ATR. So again, the good and the bad, sometimes that that trailing stop, using that as a hard stop, will sometimes prevent this type of massive sell-off from really inflicting a lot of damage. Other times, price will come down, flick that trailing stop, only to turn around and move back. So again, good and bad. You need to show both sides of the outcomes. There, Ken says, I still have WTR. WTR, I think, triggered, which is Aqua America. And yes, that one triggered a couple of weeks ago there, Ken. So certainly triggering. A couple of price volume volatility signals there on that one. Still holding up reasonably well. You can see the relative strength there, despite what's happened with the broader market. Be interesting to see what happens with that one this week. I'm not too sure what how that finished on Friday, so I'll just go and have a look at that on a daily to see what it was doing during the course of the week, to see whether it benefited much from Friday's rally. It didn't do a lot on Friday night, so again, two pin bars at the last 2 weeks. It's not the most bullish of signals. That's typically what you might refer to as a tweezer top. So those two pin bars, they're really looking like a pair of tweezers. So again, nothing to do on that one. Wait for the trailing stop, wait for some decent price action, and if that's going to occur, it will drag that trailing stop higher. Okay, so Ken said new trough, but I think it's above the second last medium-term peak. I'm not too sure what stock you're referring to there, Ken. WTR, what we are still in, we are at, for the time being, in short-term downtrend. When that turns around, it hasn't turned around yet. We'll just wait and see where that is in relation to second from last medium-term peak. If it turns around where it is now and starts heading back up, that'll be clear of that second from last medium-term peak, and therefore, on that basis, produce another setup that we can have a look at, this time next week. What we might do now is just go back to our PowerPoint and just check with a little bit of luck. Put that back on full screen, which is, as I get my, I think it's fallen out of full screen mode, so I'll have to do that and hope that everything clicks. There we go, extreme risk in both, which we've seen on Beyond Charts. So again, it just means that from a value at risk perspective, it means that those of you who are still long in the market, or perhaps new to the market, or looking to enter the market, assuming you're splitting your capital 50-50 between Australia and the US, you need to apply a market risk multiplier of 10%. 10% of your allocation, which would be 7.5% that you would typically allocate to the Australian market. 10% of that means that you are only allowed a value at risk limit of 0.75%. That's just rounded up to 0.8 of your value at risk in the Australian market. Exactly the same in the US. So making sure that, again, from the longer term perspective, that you've only got a small amount of capital exposed as value at risk. Remember, value at risk is the amount of risk you have on any of your positions where your protective stops are yet to be trailed to break even or better. Okay, so the other aspect that you might like to consider is profit at risk. Profit at risk is really the difference between what you've got in terms of profit at this point in time and where your protective stop is. So that's something that you can also consider as well as a way to manage a portfolio. It's a much more conservative way of doing it. Just a bit of a summary. Those of you who haven't caught up on the macroeconomics analysis session, have a bit of a look. We've changed the format of it. For the last probably 8 or 9 months, we've really focused in on relevant sort of data that was coming out this week, but certainly a lot of that was perhaps had much more of a shorter term type of focus. So Jeff and I have got together and thought about the session and really just putting forward the key macro themes that are impacting the market sort of from a week-to-week, month-to-month type of perspective. So I think that's important, particularly when when you're investing, trading on a more medium to longer term basis. That's going to have much more bearing on what's happening in the markets than the day-to-day type of activity. Education sessions will start next week, next Wednesday, as well. Oh, thanks for that feedback, Kay. That's terrific. And also what we'll do, it's not this particular Friday, but the following Friday, we're going to swap to the Friday afternoon session and Monday afternoon session, and we'll give that a go for 2 or 3 weeks to start with, and see how it's all going, whether it's working for everybody and everybody's getting good value out of that. And if that's the case, then we'll continue with a Friday afternoon, Monday afternoon session. That way, those of you who only invest or trade in the Australian market have got all your information well in time for Monday morning, and those of you who trade the US can join me on Monday afternoon for that particular session as well. Any questions, folks? Any charts or anything? Any comments from last week? Certainly from the longer term perspective, it is really an important time to be thinking about your capital management. Really interesting. We're having a chat with some colleagues recently about the growth in self-managed superannuation funds, and I really wonder how many people that have developed their own funds, set up their own funds the last few years, how they're starting to feel, given that a lot of them are largely, responsible for their own outcomes now, as opposed to, somebody else investing on their behalf, and how they're feeling about what's been going on in the markets. And I think this is where it's really, really important to have that longer term perspective, but also to understand the importance of that capital protection when the market's in the mood that it is at this point in time. Certainly when the market turns around and the direction is a bit more firmly established, then having the direct exposure makes a lot of sense. Question from David: which day will the New Times start? So the New Times won't be this Friday, it will be the following Friday. Okay, so this Friday coming up will be, what's today? The 15th, so it'll be 15, 16, 17, 18, 19. So it won't be the 19th, it'll be a week from there, so it'll be the 26th. So that's when we'll officially start the Friday afternoon session. So I'll send out an email and let everybody know of those particular times. You'll receive an invitation earlier in the week, ready for that Friday afternoon. And then I'll send one out over the course of the weekend for Monday afternoon session for the US. All right, folks. Well, thanks for joining me today. Hopefully, the market can bounce a little bit and carry those stocks that are in the watch list up to higher levels, and add a little bit more profit to those existing open trades. And hopefully, we don't see too many stocks close out over the course of this particular week. All right, folks, I will catch up with you later on in the week. And again, if you haven't seen that macroeconomics analysis session, please go and have a look at it, and certainly value any feedback that you have. Okay, have a good week, folks. We'll talk to you later in the week. Bye for now.